Hi guys, it's Andrew from Trading Mastery, and in today's trading tip, I'm going to share with you a strategy that was given to me by a former investment banking trader that has worked exceptionally well for me over the years. And I'm talking about a 200-day exponential moving average. So let's get to the charts right now, because I want to walk you through how you can put it on your charts and be able to use it to your advantage. Whether you trade futures, currency, stocks, indexes, whatever it might be, this particular moving average is going to be a great barometer for you to whether or not you may potentially be buying or selling in the financial markets. Let's get to the charts right now.
If you've never used a 200 EMA before, which is this yellow line through the middle of my screen here, on your Markets X platform, you can click on Indicators and just scroll down until you come down to where we can find it here, which is a moving average exponential. Click on that and make sure you put into their 200. Choose the color that you like and the size or the width of the actual moving average line, and it'll put it on your screen straight away. Now, I'm going to share with you here the 200 EMA exponential moving average on a daily chart on both the currency market, gold, and also in the index market, just to share with you some simple strategy that you may like to add to your trading plan that it's going to potentially increase your probability of success. Now, I'm just going to scroll my chart back here just a little bit to where the S&P 500 was in 2019. Now, what I want to point out here with the 200 EMA is if we see a market, if it is bullish and it pulls back to that 200 EMA on the daily chart and then gets a very bullish candle pushing up in the direction of the trend, we often find that that trend will continue. And we've seen that a number of occasions here. We've seen it right here, right there, where we see the market came back to that 200 EMA, and then when it closed back above that key level, the market took off. The same thing occurred right here, the same thing occurred here, and the same thing again occurred right here. Now, if you want to keep things really simple, what you want to look for in any market that you're trading, and I can tell you inside an investment bank and a hedge fund, most of the traders that I've worked with use a 200 EMA as to whether or not they're going to be buying or selling. In other words, if the market is above that 200 EMA, they're a buyer, and if it's below it, they're a seller. Now, recently we've seen the market fall into a bear market territory. We came very strongly down through the 200 EMA here on the daily chart of the S&P 500, straight down here. It came back up and it really couldn't close above and get that momentum back higher again. And we saw 2 consecutive days of declines followed by a very sharp sell-off. Recently, we've seen the market start to accelerate back up here to this 200 EMA. And I'm going to share with you in a moment what to look out for with respect to this particular chart, the S&P. But also I want to go back and share with you when we get 2 days of consecutive declines after a very, very sharp correction here around this 200 EMA can often mean a very bearish sign for the market. So use the 200 EMA in a very simple way with your trading on the daily chart. If we come back to it and we're in a bull market and we get a push off it with a bullish sign to the upside with a closing bullish candle, then look to take your positions to the upside. When we are below that 200 EMA and we've seen a very sharp correction in the market as we saw back in March 2020, right here, the market rallied back up and then we got 2 consecutive days of declines. What that tells me as a trader is the market is now likely going to continue this move to the downside here, which of course we can see there it have. Now, if the market does retrace back up to this 200 EMA here, and we do get a red candle closing to the downside off that 200 EMA, that is an opportunity once again to get short in a market that is bearish. So keep an eye on that, because in a moment I'm going to go across and I'm going to talk about the currency market and how to also use it in currencies, and I'm going to show you also in the gold market, works the same in oil, etc. So let's now jump across to the currency market. I'm going to bring up a daily chart of the euro against the US dollar. I'm going to show you here what I'm talking about when it comes to the daily chart and what we're actually looking at. So let's, before we do that, look first of all at the euro against the US dollar before we go to gold and oil. And what we can see here is exactly what I was touching on and talking about a few moments ago. The market came back very sharply on the euro, and it came through this 200 EMA, and it had two consecutive bearish bars below the 200 EMA. I'm talking about encircling right here. This is a very bearish sign for any market when it comes off a significant high like we saw right here. We come down through this level and we get two consecutive days of declines underneath that 200 EMA. The probability is we're heading lower. So I encourage you to look at your trading strategy and say, can I incorporate a 200 EMA with my strategy, use the daily chart, and be able to increase my probability of success? Now, you can see here the market recently rallied back up. It got some resistance right here at the 200 EMA. It pushed back with a daily bar back below it, and it's fallen back lower. Now, where I'm looking at here is entering short around the close of this bar. The stop loss would be just above right here, with the profit objective down at least 2-to-1 to the downside, which you would have picked up in this particular case. Now, again, if the market rallies back up to this 200 EMA, we get a push off here with a red bar to the downside, then it would be an opportunity, in my view, to get short. And of course, if we were to scrunch our chart up here, what we will see is that 200 EMA consistently, time and time and time again, when we go back through the market and have a look and see where we've been, what we're going to see, and I'm just going to show you another example right here, is if you're patient and wait for this market to come back up to that 200 EMA, so rather than get short here, wait for the market to come down, come back up here, then we get that bearish bar off that 200 EMA, and look at what the result has been here. Now, it takes patience, it takes discipline, but if you wait for it and you wait for those closes, what you will find is more often than not, it will deliver what you're looking for. For example, here, we didn't get the follow through right here, but we certainly did right here. And we certainly did right here, and we've had recently once again right here. Let's duck across to the gold market now, because I want to show you the price of gold on a daily chart where the 200 EMA has worked exactly the same. So what we've seen here is gold been trending higher on the daily chart. It's been moving higher. It retraced back down here, and it got some support off the 200 EMA. Look at that rally back higher there. And you could go through any market you like, any stock, any currency market, any index market, cryptos, whatever you like, and you would find that the 200 EMA on the daily chart offers a great area of support or resistance. If we can be of any further help to you in understanding how to successfully invest in the financial markets, please join us across on our website where you can get some mini courses, some free mini courses, and some great content at tradingmastery.com.au. I wish you every success with your investing, and until next time, bye for now.